You know that stuff you've heard on the show about the trend being your friend? My big interview with David Russell, Global Head of Market Strategy for TradeStation, may change your thinking on that.
I think we entered this part of the year with a lot of people expecting a strong year end based on historical seasonality. But the fact is, the market's priced in a lot of good news. And at this point in time, there are other things that are starting to emerge as potential risks, especially a slower economy and a less dovish Fed. The last two rate cuts that we saw were pretty easy to understand and kind of predict. The next one is far less clear.
He thinks there's trouble ahead. And frankly, we are talking about some trouble today because we start with Nate Miles, Head of Retirement at Allspring Global Investments. And we're discussing their 2025 retirement study, which showed that only 6 in 10 retirees or near retirees feel financially secure. And yeah, that number is down from a year ago. But you will get good news in the market call, where Brian Frank, manager of the Frank Value Fund, an absolute value manager who you wouldn't expect to be buying so much when the market is at record highs, surprises me by saying that he's fully invested right now.
And what is the truth today?
Well, the truth is that we're living the money life, and it's money life for November the 19th, but you might find that the truth you get out of this show disagrees with some truth you've heard from some other shows here. And frankly, that's a big part of what we do on this show. We're not trying to tell you, oh, this guy's right or that guy's right. We're trying to tell you, consider everything and make the decisions that are going to help you the most, right? It's a big deal. In the interview with David Russell, he makes a point about, well, it's one thing if you're looking at short-term stuff, if you're looking at 5 years out and you're looking at growth projections, then you know you're going to have things that are going to be corrections and declines, and you're not going to get straight line growth, but you're not necessarily as worried as if you just look at the short term. So even in an interview that talks about some of the potential for trouble, and it also talks about how the AI story not played out, but the cycle, he makes a really interesting comment I want you to listen for, where he's talking about what he sees from Micron Technologies. And he specifically says that Micron tends to move at the end of certain cycles. And he explains why. And that Micron has been moving of late. And it makes him wonder, does that mean that the AI cycle might be ending? Right? That's not something you necessarily are hearing almost any place, but it's not something you've heard from other guests here. So does that make it the truth? No. Does it make it an indicator worth watching? Yes. And it go back to like when we were talking about the Hindenburg omen with Tom McClellan, and it's come up in a couple of other conversations since then. The Hindenburg omen suggests that if you get a market that is flirting with new highs, but you have more companies making 52-week lows than making 52-week highs, you have this discrepancy that can be the sign of a market top. Can be, but that doesn't mean it is. So it fires signals that sometimes work and sometimes don't. That's what happens when you're talking with chartists and doing the rest. So a very interesting take. And again, TradeStation, an online brokerage platform. We, of course, had Steph Guild from Robinhood, an online brokerage platform. And I think you will understand some of the difference between the two platforms when you listen to David Russell and compare it. Because TradeStation, a little more for people who are using not necessarily just, I'm going to buy stocks kind of strategies. Robinhood, a little more for the folks, and not that Steph Guild wanted to move away from the meme stock stuff, but that is kind of been the home of meme stock traders and what have you. And they're trading much more in shares than they are in options. TradeStation more in options. So it's an interesting dichotomy there as well. Yeah, we put that stuff together, and then you have to do some of the heavy lifting, because investing, well, it doesn't have to be heavy lifting, but it has to involve you having the courage to do what you think is right and sticking with it. But yes, you're going to have to get involved and at least say, okay, here's what I trust and believe in. I will now make decisions that go towards that. Stick around at the very end of today's show, because Brian Frank, when we were in Quick and Dirty, mentions a stock that he is selling, and I missed it. I apologize. I will apologize again at the end of the show, but I'll tell you at the end of the show that, wait, hold it. The last time he was here, which was about 9 months ago, he was buying that stock. And so even the dichotomy can come up when you hear a guest talking about something and then they come back. Let me know what you think about it. Chuck at moneylifeshow.com is how you reach me, and I would love to hear from you. Today, while you are listening to the show, I will be on the train, or whenever you're listening to it, I might be done with the train, but I'm heading to New York for the Active Investment Company Alliance Fall Roundtable. I will be moderating a panel there. We'll be doing some interviews that we'll have on tomorrow's show, but we'll also have our regularly scheduled stuff like the ETF of the week with Todd Rosenbluth and a great interview with Andrew Foster from the Seafarer Funds. So you want to be here, but I can't tell you everything that we're going to have tomorrow. Hopefully, however, I have a good day of travel today. I enjoy going to these events when I can get to them. I've always enjoyed the ACA stuff, so I'm glad that we're going to have that one. Looking forward to that. Right now, I bet you're looking forward to the talk because there is much more in that interview from David Russell. I literally could have played the next clip. And by the way, some of you had told me I should do that. So if more of you want to hear that, like, hey, Chuck, it's okay to play a second clip, well, let me know. I'd love to hear that as well as we think about things that we're going to do with the show going forward. But right now, we're going forward with this show. Nate Miles, David Russell, Brian Frank. We're talking about Americans and their retirement readiness when we start things off right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at the 2025 retirement study, headlined By Default or By Design, from Allspring Global, where they surveyed over 1,500 adults. And yeah, you know how this goes. Like, I'm still waiting for the survey where somebody tells us, we surveyed a whole bunch of people. They all said, retirement. Yeah, I passed Easy Street a while ago. I'm well into the whole neighborhood. I'm not worried about anything. That does not happen. But the worries that they have and what it portends, and then the conclusions that can be drawn from that, that can be important stuff because you are getting older and you do want to reach Easy Street. Here to discuss it is Nate Miles. He is head of retirement at Allspring Global Investments. If you want to learn about the firm, allspringglobal.com. If you want to learn about the 2025 retirement study, there's a link where you find Nate mentioned in today's show notes, also on our guest page at moneylifeshow.com. Nate Miles, great to have you back on Money Life.
Thanks, Chuck. Great to be here.
I guess we're not surprised when we think about the headlines that 60% of Americans feel financially secure, but that the number of people feeling financially secure is down from last year. You know, the headlines have said people feel terrible, but oh, by the way, the market's at record highs. So how much of the issue is what we hear in the headlines? How much of the issue is people's understanding of their own financial situation?
So you mentioned the 1,500 people. I should add, Chuck, that this survey was done between April 25th and May 16th. So if you recall, that was sort of a couple weeks after the tariff announcement. And so that may have played some sort of impact on people's confidence in retirement. I don't want to belittle that impact or potential impact. I would also say that one of the things we see in the survey every year is this fear of the unknown. That every year we do the survey, near retirees, those people that are still working, always are more concerned about what their future retirement will look like than retirees. Retirees tend to be happier relative to the near retiree population, but you're 100% right. We did see about an 8% decline for near retirees between 65 and 69 in this year's study versus last year's, and about a 15% decline for existing retirees in that same age bracket, so 65 to 69 years old. So there was a rather large decline. Tariffs may have had something to do with that. I think just the kind of inflation rate for people that are on fixed income may have also contributed a little bit to that impact. And then maybe I'll just add one more quick stat here, Chuck, that I thought was interesting. We ask every year how much a retiree's spending could decline before it actually would impact their happiness. And for the past several years, it's been consistent around 25%. So 25% of my spending could go away overnight and it wouldn't really impact my happiness in retirement. That dropped about 5 percentage points or 4 percentage points this year to just over 20%. And again, likely having to do potentially with being on a fixed income and, the inflation that we've seen over the past couple of years, sort of closing that gap between the amount of spending I'm doing and where my pain threshold is for happiness, maybe, or may lie.
And one of the things that your study showed, but other studies have shown as well, is that people don't really understand like the benefits that they get from waiting to take Social Security and stuff along those lines, where they're not getting massive benefits from taking it now, but they are getting that insurance and that protection against what might happen if they wait. So how much do we have a perception problem?
I do think that is a large issue. And in many ways, if you think about the employer sponsored retirement market for a little bit, Chuck, you think about sort of how that's evolved over the past almost 20 years. So in 2026, it'll be the 20th anniversary of the Pension Protection Act passing. And that gave us the auto features that some of your audience members may have heard of, things like auto enrollment into a 401k plan when you start working for a company that has one, or auto deferral into what we call the QDIA, or qualified default investment alternative, and even things like auto escalation, where each and every single year you're saving a little bit more. So we sort of automated decision making for individuals, and they may actually reach retirement and have a decent nest egg and not actually have made all that many active decisions to get to that point in time. But all of a sudden they get to 65 years old or 60 years old, late 50s, when they start thinking about retirement, and there really are no auto features for that decumulation side. So we've got them to a good place where they haven't had to make active decisions. Now we get them to retirement, and all of a sudden they need to make a lot of active decisions. Historically, we focused on things like, what is their income needs in retirement, maybe annually or monthly? How long do they expect to live? What do they think their returns are going to be? And therefore, how much can they safely withdraw? Very, very complicated questions. This year's study, we actually leaned in a little bit more to this idea of withdrawal strategies across various types of accounts that our survey respondents have. And I think another enlightening idea around this anti-auto feature is that there really is no automated way to optimize your withdrawal strategy. So 53% of our survey respondents said they had some sort of withdrawal strategy or preference across their various taxable accounts. So think of like a taxable brokerage account, maybe a 401k or IRA, or maybe a Roth 401k or Roth IRA, how they actually withdraw assets from those. About 53% of people said they had some sort of preference. Now, that's not to suggest their preference is correct or optimal, but that means that at least half of them have no strategy at all, right? They look to withdraw assets based on what account went up the most in the past year, or which account is the largest, or some other reasons. Maybe they're taking equally across all three of their accounts. And this is yet another way where we think some of the auto features that have done so much good on the accumulation side are maybe causing a new challenge once we get to that sort of near retirement and in retirement phase, where all of a sudden automaticity isn't going to be able to solve some of the issues that we've created by having really large or a larger nest egg for many of our survey respondents. In fact, I would say in this year's study, we did focus on people with $200,000 or more in investable assets, and more than 25% of new retirees had more than $1 million in investable assets, and more than 36% of existing retirees had $1 million or more investable assets. So these certainly were people that have a decent amount of wealth from which to consume over the course of their remaining years. And again, only half of them had some sort of strategy around withdrawal of their assets.
You guys asked questions about AI and whether AI was going to be a tool that would help some of the retirees. And obviously there is skepticism out there, well, really at all levels, but we know the folks who are in retirement or near retirement are old enough that they're going to be naturally skeptical. But I can tell you there's been plenty of research that shows that AI at times is not getting the easy questions right. So are folks going to want to rely on this? When will we get to the spot where we can say, for some measure of people, AI is a suitable substitute for a human advisor?
You hit the nail on the head. There is large distrust amongst our survey respondents and the use of AI when thinking about their retirement strategy with their advisor, or whether or not they have an advisor. So about 53% of our survey respondents without an advisor distrust AI, versus 43% with an advisor have strong distrust of AI. So that clearly was prevalent in our study. And to your point, probably not all that surprising at this point. So from an advisor perspective, we would think about not leaning in with the role that AI can play in terms of optimizing the withdrawal strategy or retirement strategy for your clients, but having it live in the background, much in the same way that maybe Monte Carlo simulations have played a large role, but more in the background for the past several decades. That being said, Chuck, I will lean into one other part of our survey that I think gets to this AI sort of conversation, which is we're sort of leaning into this idea that differences really do make the difference for individuals. One of the things that our survey found was that 84% of new retirees prefer other options over target date funds. So 84%. That's certainly counter to industry convention that says target date funds will sort of consume the entirety of the DC market over the coming years as younger participants mature into their, let's say, 50s and 60s. If we think about hard data, only 2% of the IRA market is in the target date fund sort of asset class category, only 2%. So clearly with the $800 billion to $1 trillion a year that's rolling from the employer sponsored side to the IRA side of the market, there is a belief that I am different than the average and therefore need some sort of different solution. And we think that actually has some basic common sense when you think about young participants and their total wealth being mostly human capital, so the future earnings they choose to save and not spend, versus those differences as their financial assets start to accumulate and differences amongst their cohorts as they mature being more material and therefore then being less like the average. And so that was a new finding in our study. And again, making differences the difference will likely rely on more data and trying to optimize solutions for individuals, which probably has us leaning into AI over the next 5 to 7 years in increasing ways. Last thing I'll just say on the AI point, between the time the survey was fielded in late April and mid-May to today, I had never heard of agentic AI. Right, that is a new sort of topic that has really just come in the fold in the last 3 months. So a lot is going to evolve in this space. Clearly, there are issues as to its ability to answer questions particularly for something as important as retirement. But they'll keep working on it. Again, 5 to 7 years, we think it'll play a pretty large role in creating more custom optimized solutions for individuals, but clearly distrust today and not something that we would lean into from an advisor perspective with their clients.
Nate, really interesting. Thanks so much for joining me on Money Life to talk about it.
Thanks, Chuck. Look forward to talking next year.
That's Nate Miles. He's the head of retirement at Allspring Global Investments. Allspringglobal.com for more on the firm. And again, if you want to get directly to their 2025 retirement study by default or by design, well, we've got links in our show notes and on our guest page. And whether it's by default or by design, you're going to want to stick around for more of Money Life because we've got more to go on today's show. We'll be back in a moment. Stick with us.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome to the big interview on the November 19th edition of Money Life. Joining me now for the first time, David Russell. He is Global Head of Market Strategy at TradeStation. You want to learn more? Well, TradeStation's an online brokerage firm that you can find at TradeStation.com. David Russell, thanks for taking the time out to join me on Money Life.
Hey, Chuck, it's great to be with you. Thanks for having me on.
Let's start with just big picture on this market. We have a rally that had gotten us back to record highs. We have a bunch of nervousness right now that has backed us off of those record highs. Is this a real, there's a threat to the rally happening? Or is this just kind of an ordinary pause that refreshes and then we'll keep going?
No, I think from your perspective, the way you ask it, there is a threat to the rally here. I think we entered this part of the year with a lot of people expecting a strong year end based on historical seasonality. But the fact is the market's priced in a lot of good news. And at this point in time, there are other things that are starting to emerge as potential risks, especially a slower economy and a less dovish Fed. The last 2 rate cuts that we saw were pretty easy to understand and kind of predict. The next one is far less clear. So I think we have an environment here where the economy is showing real signs of weakness in different areas, and we haven't had a lot of data. So I think we're heading into a holiday season that could be one of the weaker holiday seasons in a while. We've priced in a great deal of positive news, and multiples are high. and the monetary environment might not be so favorable. So a lot of the things that were very clearly bullish are not so clear anymore.
Does that mean that as you look ahead, the anticipated Santa Claus rally and the January effect and all the positive things that people hope for, not likely to happen on your agenda this year?
At this point, no, I think that a lot of those are in question. I think the situation is that first of all, we had incredible disruption with the way the market crashed early, this year and recovered. There's been nothing normal about this market cycle, and I think that a lot of the sort of normal seasonality at this moment, I think have kind of lost relevance. We've had a really strong 6 straight months up, and we have extremely high multiples at this point in time. So I think that some of those normal seasonality things are kind of less relevant.
One of the things, of course, we've seen as the market has gotten to the record high levels, et cetera, was a market that was doing it with not that many participants. There's been a lot of talk of late about how, yeah, we've been flirting with record highs, but we've got more companies flirting with 52-week lows than 52-week highs. As you talk about this rally changing, are we also going to see a change in leadership? Because it's been everything AI. And if we're going to wind up seeing the market step back, is it going to be that the AI steps back and leads the downturn? Or is it going to be other stuff that leads the downturn?
Well, in terms of leading the downturn, I think what's interesting, you speak of 52-week lows. I'm not sure if it made a 52-week low today as we speak on Tuesday, but look at Home Depot. I think at the end of this week, we might actually look back and say the biggest earnings report this week was not Nvidia. It might have been Home Depot because Home Depot really highlights the overall weakness in Main Street that I think is emerging. I've been looking at stocks like Visa, a lot of the e-commerce stocks, like things involved in e-commerce like PayPal, and I think we're seeing that there is a lot of weakness that is really developing things in the housing market. So I don't believe that AI will necessarily be the area that will lead us lower. The AI can pause and it can have some volatility and some pullbacks. But in terms of the things leading us lower, in some ways, it seems to be a lot of the more Main Street sort of stocks that have not done very well for months now. Some of the things like airlines and the cruise ships, some of these discretionary stocks that have basically they had big rallies in the spring and they've gone nowhere for a while. Now, some of the other names that may struggle, for example, some of the big software names like Adobe and Salesforce, these are companies that never really benefited from AI and they've remained in kind of structural downtrends as well. So, from my view here, in terms of what could lead to the downside, it would not necessarily be the AI stocks. It seems like at this point in time, it would be some of those kind of names that never really benefited and have been lagging and limping as the market made new highs and they just kind of managed not to break down. Well, if we get some volatility and some broader selling, the weak can get weaker in that environment.
It's interesting because some of the names you dropped there, including like Adobe and Salesforce, could be considered AI adjacent. They're not direct AI companies, but their business would make it that you think they might be AI adjacent. AI adjacent has done very well because everything AI has done, but it's been more AI adjacent as in the energy companies and things along those lines. So will we see basically the AI bloom off the rose a little bit? And fine, it'll still be AI adjacent, but much more that pure play AI, or the way we sort of saw back in the 1990s with internet companies where we had the internet boom, but then it was, how closely tied are you? Are you pure play, et cetera? Is pure play AI where you want to be, and energy types of things as that adjacent, but not software types things adjacent?
Well, I think it depends on how directly they benefit. I mean, some of these companies, I think we've seen this kind of quiet trend of a lot of professional service companies in different ways, things like Accenture, or even companies like, I'm trying to remember some of them like Copart. And there's been some other companies that have essentially provided data and research. There's a few of them I can't remember right now, but they've all been breaking lower. And so what's interesting is I think we've seen a deterioration in a lot of kind of white collar professional service employment in general. And I think what's happening is that AI is actually eating a lot of those jobs. So you're seeing is you're actually, like today, I think it was there's going to be a new AI integration with TurboTax or something. Well, what does that do to professional services? When you look across the realm of professional services that a lot of these software companies in one way or another are connected with, as a workforce, those parts of the economy are actually shrinking. So I think right now we're in a spot where AI is actually disrupting to varying degrees a lot of these different businesses. And so I think that's what's really happening with the software. So while they might be kind of considered AI adjacent, in some ways, in the big scheme of things, AI might actually be more sort of destructive of their businesses, or at least reducing growth in their businesses. And then when you look at things that are really AI focused, what I think is interesting, in the last few weeks, we've seen this incredible strength last month or so in things like Micron and Seagate and SanDisk. These are the hardware companies. Well, these often rally at the end of cycles. So from my view here, we might kind of have been we've seen these chapters kind of AI. We had this surge in 23, and then we had a period of pause and then resumption. And at this point, we might simply be at the end of another chapter, when there could be a period of a few quarters of pausing and consolidating before we know what kind of comes next. So I think right now there are doubts about some of the scale of investment that's being done. We're seeing some of these companies start to have their credit metrics weaken because of it. And let's not forget, a lot of these growth forecasts are pointing out 4, 5, 6 years into the future. So if you're talking 2030, there's a lot of opportunity between now and the end of the decade for things to pause and pull back. And after a run that we've seen of this nature, people might actually be thinking it could actually be a matter of a few months or a quarter or two of consolidation. And that could be what we're basically entering now.
I want to use that as a springboard into maybe what you see with TradeStation customers, because as I pointed out, for those who are maybe not familiar, TradeStation, online brokerage platform, but as the name implies, it's TradeStation. It's not buy and hold station. It's not let's stay here forever. But at the same time, you were just talking about 2030 and investors who could say, hey, I can see the long-term prospects, et cetera. What are you seeing among the clientele in terms of how much trading they are doing versus how much it's by the rallies? Because at the beginning of this, when you talk about what you're seeing, it doesn't sound like you're seeing this as a buy the dip kind of a thing. You're thinking there might be something more to it, at least for a little while. So are we seeing everybody lean into every dip, or are the folks that you're seeing as your clients maybe a little bit more, I want to be tactical and not just use every dip as a buying opportunity?
I've not seen where they're going directionally in the most recent time frame. But the thing about our customers is that they're extremely agile and nimble. And the thing is, a lot of them have the ability to very quickly pivot to things like futures. So when we're in an environment that goes from a VIX under 20 to a VIX in the mid 20s, that instantly sets off alerts in people's minds that it's time to have fewer positions and to concentrate on the big indexes. So I think one of the things that distinguishes our customers is they have that ability to pivot from trading lots of small individual stocks, maybe being long options or short volatility in certain names that are in uptrends, and suddenly realize the environment has changed and I'm going to pivot. And that is what I think we often see with a lot of our customers. So when the market gets more volatile, we see attention shift very quickly from the large names, from individual names that may be more varied and different, to just the big index products, the things associated, either the futures or the ETFs associated with the Nasdaq and the S&P, and then tremendous options activity often flows from that as well.
And is that what you're seeing now? Have we moved to that? There's enough volatility, even though the market's, gotten to record highs recently, that traders are moving away from individual stocks and towards the indexes?
I've not checked our customer activity in the last couple of days. Based on historical patterns, that is what we've seen. And I think what's also interesting right now, when we look at the S&P, yesterday we had the 8-day exponential moving average cross below the 21 for the first time since April. And that sets off a lot of alarms for people as well. I think that also shows that the market has changed structurally. So while I'm not sure of like exactly what our customers have been doing, as in terms of mid-November, I haven't looked at that. I have in many ways study the historical patterns we've seen before over years of watching our clients. And that's exactly what we see in this environment. In a calm environment, when the VIX is consistently under 20, we'll see a lot of individual stocks among our top symbols. Once that VIX starts rising, those individual names disappear, and you basically see the index products dominate the activity. And I think at the end of the month, if we look back at this period, that's what I would expect to see.
That's not just what you would expect them to do. That's also the action that you would advise them, as, in your role, that you would be saying, yeah, if we're seeing more volatility, pull back from the individual names, lean into the indexes, correct? So that is
Yes.
also the advice you'd be giving right now.
Yes, because when people are when the market gets volatile, it gets correlated, and there's no reason to be playing around with individual stocks when everything can get hammered together. The indexes provide much more clarity in terms of levels and the actual trend than the individual stocks. And one of the things I've often emphasized with our clients is to kind of think of things in terms of a correlated volatile market versus an uncorrelated less volatile market. And we seem to be entering a period now of increasing volatility, potential for some more downside. And as that happens, everything gets dragged together. And then the market can have a period of crashing. And then when it recovers, you begin with a correlated rebound. Everything rebounds together. And so the market can, kind of crash. Then you get a rebound at the end. Maybe the S&P can recover several percentage points in a day or two. And if it looks like we've bottomed, then what happens is the S&P has less and less big moves, fewer big moves, and then the individual names get active again. So we've been in a period of individual stocks outperforming, individual names doing well, and now we're pivoting back to a time when everything moves together, and that's when the futures that's when the DNA of TradeStation is futures trading, and that's when even a lot of clients who might have come on board as stock traders, they now have that ability to basically leverage one of the most powerful futures trading platforms in the industry.
So as we go through this period, you mentioned a couple of different names. You talked a little bit about AI, but what are the areas of the market that look most attractive to you and maybe least attractive to you right now? Sectors.
All right, so I would say that the AI, when you look at what we've seen with the most recent moves in some of the memory chip stocks, that suggests that we're kind of at the end of this phase of the cycle. Not to say AI has done or anything like that, but that could be consistent with something that results in a pause for a quarter or two, or maybe a little longer. The thing is, if you look historically, Micron tends to rally at the end of the chip cycles, and Micron has been leading, and that is, potential kind of warning. As I look out, I mean, I think some of the things that are kind of interesting, we've seen this kind of shift to things like healthcare. And I think healthcare has been lagging for a long time, even though if you look at the jobs data and the economic data, you can see that healthcare is one of the main growth drivers of our economy, but the healthcare stocks have been lagging. So it's kind of an interesting opportunity. We also see a decreased regulatory and political risk with some of the pharma names that have had good earnings recently. So, from my perspective here, healthcare is actually something that's starting to assert itself. It's been the leading sector in the last few weeks. And I think we're seeing a shift to that. It's non cyclical as well. So, if we do actually have the other thing that I think here is that we seem to have a recessionary pattern developing on Main Street. So we're expected to have a relatively weak retail season, a holiday shopping season. We see the news today from Home Depot. And I think when we look out overall, you can see a lot of the kind of financial stocks and the cyclical names have really broken in the last few days as we speak on, Tuesday, the 18th. So I think that that is telling us that we have more risk here of a kind of, recession. Not to say it's going to be an official recession, but the market can take on that sentiment. It's interesting to see that with all the strength we saw in a lot of the industrial stocks, things like railroads have never performed particularly well. And then if you look at some of the other names that I've always looked at a stock like Cintas because they provide uniforms for millions of people. Well, that stock's been struggling for most of the year. So that actually tells you something about the job market. So I think AI boosted a lot of industrial stocks like Caterpillar and many others, these sort of, HVAC names, engineering names. They did very well because of AI. And I think that actually has obscured weakness in the non AI economy. AI spending has obscured weakness in the consumer. And as AI becomes, maybe if it just kind of grows a little bit less, or at least the market focuses on it less, we actually have the potential for people to turn and suddenly realize and say, wait a second, we have a weak job market. We have weak consumer spending. We have falling home prices. We have economic uncertainty, the second worst consumer sentiment ever. And you put those things together, it seems now the market is going to look and see some potential weakness on Main Street. And I think that's kind of the trend we're setting up for here.
And in this downturn that you see coming, et cetera, is there a support level, an expectation for you of, here's where we go if things are normal and here's my sign that things have gotten ugly?
Well, the first level that I had identified for clients was the October low around 65.50 on the S&P 500. I think it was October 10th when the president got started talking, with trade war, China again, all that stuff, and we recovered from that. But there was a big breakdown on October 10th. That's the first area I'm watching for support. Now, I do think we have to realize that over time here is that the earnings multiples are still quite high. So if the S&P were to go to something like 20 times forward earnings, you're looking at something that could go back towards 6,200 or something. So I wouldn't say there's anything that dramatic immediately in the cards. But the first level I'd be watching would be 65.50 on the S&P, and anything beyond that, from my view, would be kind of speculation.
David, really interesting stuff. I wish we had more time. We don't, but we'll make it again down the line if you'll come back. So thanks for joining me today on Money Life.
Sure, Chuck. It was great to talk to you.
That's David Russell. He's Global Head of Market Strategy at TradeStation. It's TradeStation.com if you're looking for more information. And if you're looking for more of Money Life, just don't go anywhere, because up next, it's Market Call time. Brian Frank, Absolute Value Manager from the Frank Value Fund, he's here talking stocks when we come back in just a moment. This is Money Life.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Brian Frank, manager of the Frank Value Fund, is here. We're talking absolute value investing now on the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines buys and sells, what they see happening broadly on the market, and how they are putting it all together. And returning to the show today, Brian Frank. He is the president of Frank Capital Partners. He's the manager of the Frank Value Fund. Frank Capital Partners, by the way, also runs the Camelot Event Driven Fund, West Hills Core Fund, and others. You can learn about what they do by going to frankfunds.com. But I will also tell you that every now and again, a member of the Money Life audience says, well, why don't you always say what like somebody's Morningstar rating is or what have you? And I think it's the Frank Value Fund that is one of the reasons why we do not say that, because we tell you, you go after the manager and you learn about the methodology rather than looking in the rearview mirror to see what stars somebody's getting. And over the time I have interviewed Brian Frank, which is the entire time of Money Life and even beforehand, he's gone from 5 stars to 1 star, and now he's back again at 4 stars. And that's because he sticks with his methodology, and he's not that worried about the moment-to-moment performance. He's worried about the long term. Again, you can learn more at frankfunds.com. Brian Frank, always great to have you here on Money Life.
Great to be here, Chuck. Thanks for having me again.
You are the one who we use to define absolute value, because value does have to be defined, but we want people to know you are pretty rigid and pretty like, this is how I do it. So clue everybody in who's just learning about your style now.
That sounds like I'm the most stubborn fund manager you have on here, but I guess I'll take that.
It's not stubborn. It's persistent. And no, you're not. We have plenty of managers who are persistent. They just aren't necessarily willing to ride it out in the face of when is this going to happen for you? And you are willing to ride it out.
Yeah, I appreciate that. And look, it's worked for us. So yeah, we're absolute value managers. I've been that way since 2004, which means that we look at each company and we figure out what we would pay for it. And that's the absolute value. If it's trading below that, we're going to buy it. If it's trading above that, we're going to pass and kind of wait and be patient. Other managers will do relative valuation, meaning right now, the S&P is trading at 22, 24 times next year's earnings. If a stock in the S&P is trading at 18, they probably would buy it, but that's not an absolute value to me. 18 times earnings, if you don't have a lot of growth, is still a pretty expensive stock, even though relative to the S&P, it's cheap. So we have our idea of absolute value. We buy 20 to 30 stocks that fit that idea. And what we added about 4 years ago in January of 2022 was we need catalysts to get this value out, because lately, since a lot of investors have been going towards ETFs and indexes, there's not really anybody there to bail you out and to tell you, to release that value. You don't have investors coming in if your stock trades at 10 times earnings, because valuation is not really a consideration of most other investors when they're indexing. So in 22, we added something to release the value, like a stock repurchase, a special dividend, M&A, something like that. It's got to be coming to us in some other way. And that's made all the difference. So in the last 4 years, we've beaten our index every calendar year by an average of 4%. We've actually outperformed the S&P and the NASDAQ since January of 2022 because we were up in 2022 and the NASDAQ was down 30%. The S&P was down 18%. And we've kept up here in the upside as well. So it's going very well since we've tweaked the strategy in that respect. And we're still actually finding a lot of stuff. I'm actually fully invested today and very excited for the future because it finally looks like some of the excitement's coming out of tech land. And I think the obvious place to go would be towards value.
Wow. I mean, fully invested at a time when the market is near record highs and not worried about valuations as you're getting in. I mean, you're always worried about them, but not sweating the valuations and keeping money in cash. That is saying something about these market conditions. I am curious because catalyst is the hardest thing to, when I talk to anyone about a catalyst, the standard answer, David Trainer from New Constructs, man, my crystal ball's broken. It's in the shop. Nobody has the ability to say, here's the catalyst that's going to actually pay off. I'm curious, since you now say it's not just got to be valuation, but valuation with a catalyst, how many times do you find a stock that everything looks right and then you don't have the catalyst? Like, again, you're looking for a small portfolio, but how much does that winnow down your choices?
Not as much as you would think. So when I say catalyst, I'm not the event-driven guy who's going to predict that these two companies should merge or something like that. I'm a dumb value guy, for persistent, as you would say. We look for a stock repurchase program that's already in place. So they've already approved it. They're already buying back stock because a lot of companies should buy back stock, especially if their valuation is low enough. But management always finds something else to do with that money. And it's usually building an empire or building a new headquarters or doing R&D on some, new area that they want to go into. We like managements that stick to their knitting. And when the cash is just flowing in and the valuation is low, they can buy back a material amount of their stock. If that's already in place, they're already doing it, then that's a catalyst for us. So it's not too difficult to find those. We make sure it's a sustainable repurchase. So it's coming completely out of free cash flow. They're not using debt to do it or something else. And still, they don't always work out, to get back to your point there. I would say, about a third of them don't work out. And we're taking short-term losses, which is tax efficient, and moving it on to the next thing that hopefully does work out. And we hang on to our winners and generate long-term gains that way.
I heard you in that prior answer talk about how you're not just fully invested, but that you're loving technology. It can't be the Mag 7 technology. Those valuations cannot possibly be justified by somebody who is doing absolute value. So where in the technology sector are you finding your kinds of values? And I will say that, wait, I'm just going to point out, you may tell me I'm wrong. I have not looked at your portfolio, but I know you have held Apple in the past and you may still have it now.
We do not have Apple today. It's trading at 40 times earnings, which is a breathtaking valuation, even for a company that's growing 5 times as fast as Apple is. But no, what I love about technology is that investors are finally starting to focus somewhere else. So we don't have a large allocation to technology, maybe about 5% of the fund compared to, 35% now on the S&P 500. But we are aware, and I think this is why our value fund has done better than most other value funds in the last 4 years. We're aware of what the Mag 7 is spending on. And the big winners in the fund this year have been electricity stocks. So all those data centers, all that CapEx that the Mag 7 is throwing around, the bottleneck is electricity. There's just not enough generation in the United States to power all of these data centers. So our independent power producers, NRG Energy was our biggest holding, and Vistra, the ticker is VST, owns I think it's the second largest owner of nuclear power plants in the country. They've done spectacular over this time period because power prices are going up. The deals to co-locate a data center gives them a longer contract at a higher margin than they're used to. And still, it's very hard to construct power, even though you can build solar and wind quickly. Data centers need power when the sun's not shining and the wind's not blowing. So it comes down to natural gas and nuclear, which is what we've been much more heavy on.
Are there areas of the market, and I assume that there are, that you can't even come close to touching right now with the market at record highs? Or because we've heard so much about this being a narrow market where it's been led by the Mag 7 and a few companies, are there things that you can find everywhere?
We're much more focused in consumer staples, which would be our number one sector. So my index is about 6% consumer staples, and our fund is about 30%. So that's one of the advantages we've built into our fund is it's called benchmark agnostic, meaning if I see something in a sector that's awesome and I want to go heavy, I'm allowed to go heavy. We're probably not going to go much beyond 30%, but already that's much larger than the index. So we're overweight in terms of the index against consumer staples and even consumer discretionary, kind of the more conservative discretionary companies that people will buy even if the economy gets weak, because we're a little bit worried about what's happening with the unemployment rate. And we're definitely underweight in technology. Like I said, we're only about 5%, and our index is anywhere from 15 to 30%, depending on what index you look at. We're also underweight industrials. So industrials in small and mid cap land, where my fund plays, make up a large portion of the index. We have zero industrials. I don't buy it. I can't find, there's not good absolute value there. There's not a lot of catalyst there. And they tend to be more cyclically exposed to the economy than I'm comfortable with. So it is a bifurcated market. The consumer staples that we have are breathtakingly cheap. And there's actually M&A going on in that space. We saw a few weeks ago that Kenvue, the owner of Tylenol, got taken out. Treehouse Foods got taken out, and these are all getting taken out at premiums to where they're trading in the public market. Our companies, in my opinion, are actually cheaper than those two companies and better set up and growing quickly and throwing off even more cash. So that gives you an idea of why I'm excited and fully invested. But nobody cares. They care more about the technology and the sexy stuff than my boring consumer staples companies. But the cash is there. The valuation is definitely there.
Give us an example or two, a poster child from because you've given us some on the energy side, but in the consumer staples side.
So we own the beer companies. We own Boston Beer, which is the owner of Sam Adams. Really, it's not a beer story. It's more, they call it Beyond Beer. So it's more about like Twisted Tea and, the hard seltzers and those types of things. They just came out with Sun Cruiser, which is a competitor to High Noon. Never traded this cheap, I don't think, as a public company. And the founders just came back in, and there was a rumor that he was going to sell to Suntory, the Japanese conglomerate. That could happen, but I think that's got to happen over $300 a share, and Boston Beer is below $200 a share right now. So we not only like Boston Beer Company, but we also like Molson Coors. The ticker is TAP, T-A-P. That's the owner of Coors Light and Miller Lite and Molson. But again, that's also a Beyond Beer story. They're growing quickly more in the premium space, and they're growing in the not beer space because beer seems to be in a cyclical downturn right now. But both of these companies are very cheap. They're buying back stock. Molson Coors pays a nice dividend while we wait. So that's the catalyst, is the shares are shrinking. So even if your sales are flat, you can grow earnings by buying back shares. And that's definitely what Molson Coors is doing.
Well, and I should point out, Boston Beer, maker of Sam Adams, their ticker is SAM. And no, I do not know the tickers of every beer company off the top of my head, but I do know most of them. Now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
I've got a good feeling about this.
And you should have a good feeling because, well, value is an investment style that people can get behind. Absolute value is taking it out a little bit to an extreme, but again, when you're fully invested, that's a great sign for the market. Brian Frank, manager of the Frank Value Fund, has told us he's fully invested. It's FRNKX, frankfunds.com, and now we're going to put him to your test. And if you want to test our guests, send your name, your hometown, and the ticker symbols you're interested in to Chuck at moneylifeshow.com. We start today with a request we got from Ted in Cincinnati for Energy Transfer. It's ET.
I love the pipeline companies. I think Energy Transfer is a buy. There's a huge push towards natural gas, and that's where Energy Transfer is spending their money. And you get a 7+% dividend while you wait, and it's non-cyclical. They just charge a flat fee for whatever's going through the pipe, so it doesn't really matter what the price of oil is.
That's a buy on ET, Energy Transfer.
Buy it outright.
Staying in energy, Amy in San Diego wants to know about NextEra Energy, ticker NEE.
I like NextEra Energy as well. I mentioned that I own the independent power producers. NextEra is a public utility, but they just did a deal in Iowa, I think with Microsoft, one of the major Mag 7 companies, to reopen a dormant nuclear power plant. So we're trying to find power in this country, and the utilities like NextEra are well positioned for it.
I want all the power you can give me.
Well, not quite all of it, but a lot of energy and a lot of power. This was a buy on NEE, Next Era Energy. Tony in Henderson, Nevada wants to know about Organon. That's OGN.
We've been looking at the generic pharma companies, but unfortunately for Organon, they just had a pretty big restatement of their financials. And with a company with as much debt as Organon, that's a pretty big red flag for me. So they might upset their lenders. I think it's a sell.
And I'm curious in that space, because we've seen a rally of late in healthcare and in biotech. So you'd love to be positioning value buying and then watching that happen. Is that a space where you can find much right now?
I'm sitting on the sidelines, but Teva Pharmaceuticals and Viatris, if you like that space, look a lot better to me than Organon. So I would take a look at Teva or Viatris.
So still, Organon, OGN.
Oh boy, that sounded bad.
Yep, it did. That was a sell and a void. Our last two requests today go to Richard in Chula Vista, California. The first is for QUBT, that's quantum computing.
Well, I think the bubble is starting to pop in quantum computing. It's an exciting concept. There's a lot of interesting tech involved, but there's no revenue. And what has made us more bearish on the space is that all these companies are actually issuing shares. So QUBT has issued about $1 billion of shares in the last 4 months. That's more supply, and that's diluting the holders. So it's kind of the opposite of a stock repurchase. So I think quantum is a sell.
You're going to lose everything you have, and you're not going to have anybody give it back to you because it's a stupid move on your part.
Yeah. When they're issuing new shares and the rest, that might be a stupid move on their part. One last request, again, from Richard in Chula Vista, California. It's for Altria Group, ticker MO.
Just like Energy Transfer, you get a nice dividend in Altria Group. I think it's a solid company. Moving towards smokeless tobacco is a great idea, and it's recession-proof. So I think MO is a buy.
We finish on a high note. That's a buy on Altria Group, ticker MO.
You can see your equity increase tenfold.
And we love increasing our equity, but we also love getting a chance to catch up with Brian Frank. Brian, always great to do this. Thank you again so much for the time. We'll talk to you again down the line.
Thanks, Chuck. Appreciate it.
Brian Frank is manager of the Frank Value Fund. It's FRNKX, frankfunds.com to learn about it and its sisters, Camelot Event Driven, West Hills Core, etc. And we'll be back. We'll let you know where Brian agreed or disagreed with some recent guests. We'll set you up for tomorrow when our show is going to be coming mostly from the Active Investment Company Alliance Fall Forum in New York City. So stick around. We want you to set you up for that before we go.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
We are back to wrap this one up, and that's good because I got to get on the road. I'm heading to the Active Investment Company Alliance Fall Roundtable in New York City. No, I'm not taking the bus. I'm going by train today, and that is a little faster and maybe a little more comfortable, and the schedule is a little less demanding in terms of when I get to leave, but it's a long day. So that's fine because we've got some great things planned for you for tomorrow's show when, of course, Todd Rosenbluth will be here because it's Thursday. He'll have the ETF of the week. And we'll have Andrew Foster from the Seafarer Funds, one of the best, but also one of the most interesting emerging markets managers out there. But before we get to tomorrow, we have to wrap this one up. And there was some crossover in that interview with Brian Frank. And it's interesting. And I have to tell you that in that interview, I made a small mistake.
I'm sorry, but I messed up.
That's because when we got to Organon, ticker OGN, and it was a sell, well, if I took Brian's crossover with himself, which admittedly was more than 6 months ago, he was last on the show on February the 10th. But at that point, he was buying Organon. And I should have checked that and known.
It was a simple mistake, and I'm really sorry.
I did not ask him about when he made the switch, which would have been good information for you to have, because again, he liked the company enough to buy it then. He's just selling it now. And he explained that conditions have changed and why he was selling it. By the way, Richard Howe from Stock Spinoff Investing, he was buying that stock when he was here on June the 24th. But before we had gotten to Organon, NextEra Energy was a buy today. It was a buy from Brian Potts of the Dems Fund back on October the 22nd. It was also a buy for Jay Hatfield from Infrastructure Capital Advisors on August the 29th. Then you got to Altria, ticker MO. It was a buy today. It was a seller and avoid from David Brady of Brady Investment Counsel back on May the 12th, which I guess technically is a little bit more than 6 months ago, but I still looked it up. So yeah. I've told you what's coming on tomorrow's show, but you might want to get busy today because there are a number of celebrations. It is International Men's Day. Now, I don't know, is this an international celebration of men or is this a celebration of international men, right? Like there's stocks and then there's international stocks. Are you only celebrating the foreign ones, in which case I'm not included in the celebration? Or are you celebrating all men, in which case I am?
I'm very confused.
Yeah. I am too. But either way, it's International Men's Day. It's also Have a Bad Day Day.
I got a bad feeling about this.
Yeah, when somebody says have a nice day, today is supposed to be the day that you say have a bad day. You know, it would be a bad day if you could not find a bathroom, and today is World Toilet Day. What other sounder would you have expected us to play? It's also National Play Monopoly Day, National Blow Bagpipes Day, and it's National Education Support Professionals Day. My stepdaughters, Taylor and Mackenzie, are both educational support professionals in their own right. They're special ed teachers working with small groups, so sometimes they're considered support. However you want to consider them, educators should be celebrated, and it is American Education Week. And then on the food front, well, it's not really food, it's all drinks. It is National Carbonated Beverage with Caffeine Day. Yeah, that's about the carbonation, not the caffeine. I might have caffeine in some carbonated beverage today if I'm feeling tired and need a boost. It's also National Macchiato Day. I'm not a coffee guy and I'm not a macchiato guy, but I am a Zinfandel guy, and it's National Zinfandel Day. Yep, I could go for one of those maybe when everything's done and I'm heading for home. My guests today were Nate Miles, the head of retirement at Allspring Global Investments, online at allspringglobal.com. David Russell is the global head of market strategy at TradeStation, TradeStation.com. Thought that was a good interview, though it's interesting to note that the market actions, thinking, and mentality of traders may not be the market actions and thinking of you if you're a long-term investor who listens to this show. And then, of course, Brian Frank from the Frank Value Fund, frankfunds.com, online for them. Thanks to those guests. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Peter Lynch, who said, "The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed." Yeah. You do have to try to figure out where your gut comes in, where the emotions come in. And if you want to minimize emotions, you'll remember what I tell you every day, which is, until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. We'll see you from New York tomorrow with more of Money Life.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.